Good morning, ladies and gentlemen. Welcome to the LIC Housing Finance Q2 FY23 Investor Conference Call hosted by Axis Capital Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Praveen Agarwal from Axis Capital. Thank you, and over to you, sir.
Thank you, Lizanne. Good morning, everyone, and welcome to the earnings call of LIC Housing. From the management team, we have Mr. Y. Vishwanath Gaud, MD and CEO, and Mr. Sudipto Sil, CFO, to take us through the key highlights of the results. I would request Mr. Gaud to take us through the highlights, post which we'll open the floor for Q&A. Over to you, Mr. Gaud.
Thank you, Praveen. Thank you. Very good morning to all of you. I extend a hearty welcome to all of you to the post-earnings conference call of our LIC Housing Finance Limited. As you are aware, LIC HFL declared its Q2 FY23 results yesterday. I have with me our COO, Mr. Ashwini Ghai, and also our Sudipto Sil, the CFO. Prior to detailing the operational aspects, I would like to highlight that in the current fiscal year, RBI had increased the repo rate by 190 bips in 4 consecutive MPC meetings in line with the monetary policy tightening across the world due to inflationary pressure. Consequently, the company also raised its LHPLR by 175 basis points in the current fiscal year till date. The key highlights of the quarter results are as follows. Total revenue from operations were 5,086 crore as against 4,708 crore for the corresponding quarter of the previous year. It is up by 8%. Outstanding loan portfolio stood at 2,62,336 crore against 2,37,660 crore as on 30th September 2021, reflecting a growth of 10%, out of which individual home loan portfolio stood at 2,16,771 crore as against 1,88,348 crore. It is up by 15%, and now it comprises around 83% of the total portfolio. Total disbursements for the quarter were 16,786 crore as against 16,110 crore. It is up by 4%. Out of that, the disbursement in the individual home loan were 14,300 crores as against 14,330 crore disbursements. And then disbursement in the project loans were 407 crore against 353 crore for the same period previous year. It is up by 15%. Disbursement for the quarter has been stable, and also there has been sequential improvement in the same. Housing demand continues to be fairly strong as we enter into festive season and into the second half of the year. Disbursements in the home loan segment appears to be stable. The success of our HOME app has helped our company to improve penetration in the young home buyer segment. Sanctions through HOME app during Q2 FY23 were 9,159 crore. Net interest income stood at 1163 crore as against 1173 crore for the same period in the previous year. Net interest margin for the Q2 FY23 stood at 1.8% as against 2% for Q2 of FY22. There has been a sharp decline in the NIM sequentially from Q1. As a conscious exercise, we have been retaining retail assets for better portfolio growth, especially in an increasing rate environment. Consequent to that, there has been some impact on modification loss to the extent of about 275 crore and has dented the NIMs for the quarter, and also due to some lags in transmission of higher rates on the portfolio. Also, with 115 basis points of repricing effective on entire portfolio from 1st October 2022, there is likely to be significant increase in the interest income in the current quarters. Profit before tax for the quarter was at 378.85 crore as against 308.95 crore in Q2 of FY22, a growth of 23%. Profit after tax for the quarter stood at 304.97 crore as against 247.86 crore for the same period previous year, with a growth of 23%. In terms of asset quality, the stage 3 exposure at default as on 30th September 2022 stood at 4.9% as against 5.14% as on September 30th 2021. Total provisions as on 30th September 2022 stood at 6,521.89 crore, reflecting a provisioning covering of 44% as against 43% as on 30th September 2021. This includes 535.50 crore for COVID-19 related provisions. ECL provision for assets recategorized as NPA as per RBI notification dated 12th November 2021 is 118.37 crore. There has been some improvement in retail assets by little over 700 crores across IHL, NHI and NHC. However, there is increase in NPA in the project by 540 crore. Overall, there is a decrease in stage 3 sequentially. Also, during the quarter, we have taken technical write-off of 191 crore in retail asset category. On the funding side, we witnessed an increase in cost of funds, which stood at 7.1% as compared to 6.76% as on 30th September 2021, attributable to consecutive repo rate hikes of 90 basis points by RBI in Q1 23 and 100 basis points in Q2 23. Incremental cost of funds also have inched up and stood at 6.89 for Q2 FY23. With this brief introduction, I would like to invite you for your queries. Thank you.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Maruk Aditya from Nuvama. Please go ahead.
Yeah, hello, sir. So why did margins decline so sharply? You said as a conscious decision to retain retail assets and also some lag. So could you explain in detail what led to such a sharp margin decline? Because I thought in the last call we had guided to stable to maybe slightly better margin. So that is my first question.
Okay. Yeah, please continue.
Yeah, my second question is that the leverage ratio is on the higher side. Now it's crossed 10, not on an average on a total asset basis. So any thoughts on that, on equity raise? And the third is on NPLs. So NPLs stay higher than the 4Q levels and they have inched up even in third quarter. So any thoughts on that?
Yeah, good morning, Maruk. This is Sudipto here. Of course, we just discussed about in the opening remarks, MD mentioned about the retention, etc. As far as the margin is concerned, yes, obviously there has been a sharp decline in Q2 as compared over Q1 and also year on year. What was mentioned in the opening remarks is that, and if you recollect in the previous calls, we had said that we are trying to retain assets, especially the high quality retail assets. We are attempting as a conscious strategy to retain those assets, especially in an increasing rate environment. And this also was a conscious effort to move those assets from the fixed rate interest regime to the floating rate interest regime. And that is exactly the reason why this has happened. There has been obviously a upfront discount or a reduction in interest rate that was offered to those customers because they were basically very high quality customers, almost like a zero NPA customers. But the overall thought there is to ensure that we are able to retain those customers with a long residual life in a floating rate environment. And if you actually look at the fact after the retention was done, we had also increased the interest rates on the PLR several times to the tune of almost 175 basis points in the last 4 months or so. So that is the reason why this impact of the 275 crores, which we had discussed in the beginning of the call, that is the reason why this has to be done as per the accounting treatment under the Ind AS.
Got it. But in these assets,
for the full year FY23, we're very confident that we can deliver an improved over FY22 margins.
okay, got it. But this was like a proactive decision, or there were actually a lot of prepayments or takeovers, and that's why you chose this?
So it is a combination of both. We are in a competitive industry, and there will always be competitive pressures and people who would like to move out. So it is actually a conscious effort, a conscious decision taken that yes, we need to retain good quality, high quality customers with very good CIBIL scores, and also we have to ensure that they are not in a fixed rate regime, because in an interest rate environment which is increasing, a fixed rate regime is actually not conducive for the overall ALM. So it's actually a decision taken on both the accounts, and it is actually a decision which is taken keeping the next several years in mind, not only one quarter.
Got it. And now is all the conversion fully done, or you could see some more in the third quarter or so?
Yeah, unlikely. Very unlikely.
Okay. And on NPL and leverage?
Leverage, I think we are comfortable. In fact, if you look at the tier 1, and especially with the scale-based regulation kicking in, the requirement of tier 1 actually is lesser than the earlier NHB regime, which used to be around 10%. Now the tier 1 has been requirement has been reduced to 9%. But overall, if you look at the leverage, it is still within substantially within the range of the allowable limit. It is around little less than 10, 9 point something.
Okay. And NPL? And also the technical write-off, what was that on? And it's through the PNL. Is it, or it's...
See, actually, there has been some improvement. In the last call, we had said that there will be an improvement on the recovery. It was visible, if you recollect. And within the quarter itself, we have been able to improve the collections and reduce the NPLs by almost 800 crores, and that has happened through on-ground collection. There has been some deterioration in the asset quality in the project loan side, and also the percentage is getting further distorted because the outstanding loan in the project loan category has also come down sequentially by almost 5%, which on that basis is quite significant. Pertaining to your other query on the technical write-off, yes, the technical write-offs mean that the on-ground follow-up, recovery, legal, everything continues as it is. But these are loans which have been more than 3 or 4 years NPA, and they have been fully provided for. So this is actually done through the PNL as is required in the Ind AS accounting system.
Okay, thanks a lot. Thank you.
Thank you.
Thank you. The next question is from the line of Dhaval from DSP. Please go ahead.
Yeah, thanks. So just on margins again, so on the yield side, you mentioned that certain loans were converted from fixed to floating. If I look at the data, about 2% is the increase in floating loan, which translates to about 5,000 crore. So what's the impact, the NII impact of this fixed to floating, if you could just quantify, to get a sense of what's the overall magnitude of change that we've seen in this particular quarter. And the other related point is, we apart from this impact, we highlighted last quarter that from 1st of July, we had taken 60 odd basis point PLR hike. We do not see the impact in the numbers in this quarter. Any specific reason again? Thanks.
Yeah, Dhaval, actually, if you, I'll take your second question first. If you actually look at the spreads and you compare it with the weighted average cost of funds, the spreads actually are reflecting a 7 basis points expansion over June numbers. And you know that the cost of fund has increased point to point by about 40 basis points. So the translation of 60 basis points on the PLR generally happens with a lag because not all the accounts are eligible for a repricing, especially the NPA accounts and accounts which have been freshly disbursed. But apart from that, it has been translated. But that 7 basis point is because there has been a corresponding 40 basis points increase on the cost of funds during the same period. But certainly it has got translated. You are probably not getting to see it reflected on the margins. I understand that is your query, and that has happened because of the reasons that we just discussed, because of certain lumpy items in the on the negative side of the income has probably weighed down the increases. And also one has to keep in mind that sequentially there has been a shrinkage in the project loan portfolio by 700 crores, and year on year it has come down by almost 2,000 crores. Yeah. Project loan is the high yielding portion of our book which earns us interest, average interest of around 12 to 13%. So there also there is an impact of reducing interest income on the project loan, which has led to a reduction in the overall increases on the revenue from operations.
Compared to last year, more than 20% reduction is there in the book size.
Yes. So that is also having an impact. That is the reason probably why you are not getting to see the increases in the income corresponding to the increases in the spreads.
Sudipto, could you quantify the specific impact of fixed to floating in absolute rupees crore? What's the kind of impact hit we have taken?
See, I'll tell you exactly what I'm telling. That is precisely what we said. That 275 is the accounting loss that has been or modification loss that has been accounted in this quarter.
Apart from that, any other item?
Yeah, apart from that, estimated about 95 crores reduction in the interest income from the project loan side. These are the two bigger impacts.
So if we adjust even
around 360 odd crores.
Yeah, so even if we adjust these two items, the NII would have been 1530 or 1525 crore approximately compared to 1610.
No, it would have been closer to that because there also is a fact that there has been increases on the cost of fund side. The interest income notional gain on the net of the increases in the spread side would have resulted to 200 crores. Around 220 crores is the actual increase in the cost of funds. So 20 crores come out from that. So there are small pieces which keep on adding.
Impairment
so
of 70
yeah.
crores.
So these are small 20-30 crores from here and there, but majority of these two are this 275 and this 95.
Got it. But Sudipto, the point is that only
total will be around 450 odd will be the difference.
Yeah, so the point, Sudipto, is actually the first part which you replied saying that actually the spreads have expanded. My point is that even if you adjust for the new cost of fund, the delta, 200 crore delta we saw in the interest expense line, even adjusted for that, the NII is not going up, which is the whole point that there is some other impact which we are not able to figure out. To say that
no, these are the only two major impacts. Actually, these are the only two major impacts.
That's all, nothing else in that.
Obviously, there will be cases of normal retirement of existing loans, which would have been going at higher cost. That also is there. That is a normal behavior. So there is nothing abnormal in it. So every quarter there will be this kind of normal repayment-led decline in interest income if a high-cost loan goes off the book in a normal manner, not in a pre-closure manner.
Got it. Thanks. I'll come back. Thank you.
Yeah.
Thank you. The next question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead.
Yes, thanks for taking my question. So again, kind of coming back on the NII and the margins, while you have explained what led to this sequential decline in NII, I mean, what we're trying to understand is, I mean, what proportion of this could recur again in the third and the fourth quarter? I mean, components of modification loss or this continued reduction in interest income from project loans and couple of other things that you highlighted, smaller pieces. What part of it could again recur in the third and the fourth quarter? Alternatively, if they will not recover, is there a case for estimating a strong recovery in margins, especially in the fourth quarter of this fiscal year?
Yeah, third quarter only, from 1st of October, there is a pending increase of 115 basis points in the entire pool of loan book. That is around 2.5 lakh crores, and that has already kicked in because whatever increases in the PLR we had done in the second quarter in August and September, that has already translated from 1st of October. So that impact will certainly be a positive accretion to the to not only the spread but also to the net interest income. So that is one thing which is there. To the extent of what is going to be the prepayment on project loans, I mean, I think the project loan portfolio has shrunk to an extent that further exits are very limited, especially the high yielding. And there also, if necessary, we might actually retain good assets and offer a better rate of interest. So that is again a commercial call that we will be taking as and when such a situation arises. But disbursement growth on the project loan is expected to nullify such shrinkages in Q3 and Q4.
And already in the current quarter, Q3, even the month just now ended also has shown good results, almost in the collection efficiency.
Understood. So the other question again is...
It has to be understood that whenever any such retention is done, it is done on assets where the credit cost is zero or near zero. So the asset quality is of primary focus. That is
for long.
And the repayment on those assets are substantially long, so that any kind of kind of front-ended losses will be more than offset by the continued earnings on those assets. And especially if it is a conversion from fixed to floating in a high increasing rate scenario.
Correct. Understood. Sir, I mean, again, a related question here. I mean, I recall even last quarter and this quarter, we talked about, I mean, various retention exercises that we've taken. And like you explained, for top-notch quality customers where credit costs were very low or zero, like you explained. So is there a significant kind of pressure on customers wanting to take balance transfers, but I mean primarily because of the interest rates which are being offered, and because of that we had to do this retention exercise. And like you have another 2% of fixed rate book outstanding, can we expect that, let's say over the next 2 quarters, these 2% customers will also be converted into floating rate and would lead to again some kind of a NPV impact or a modification loss?
See, actually, the retention of good quality assets is always a desirable proposition, rather than allowing the assets to go and consume further expenses to originate further new assets. If you have got a track record tested customer, it is always better to retain such customers. And obviously, everybody will be looking out for such customers. But if you are having those customers within your fold, then you should be able to retain them. So that is a strategy that asset growth has to be given that priority. But more importantly, it is not an asset growth which is given priority irrespective of quality. It is an asset growth which is given priority with the best quality.
And also with a long duration also.
And with a significantly long duration, which will continue to earn in future.
Right. That's what we...
Understood, sir. Understood. So last question is on the asset quality bit. Firstly, if you can share the product-wise gross stage 3 numbers that you share on different product segments. So home loans, non-housing, individual, commercial and project loans. That's the first. Yeah. And secondly, sir, last quarter you talked about, I mean, this there could be potential slippages from the restructured pool. So firstly, how has experience been on that front in the second quarter? And in the third and the fourth quarter, is there a reason to believe that, I mean, in the restructured pool, wherever moratoriums are going to open in the third and the fourth quarter, we could see some slippages from the restructured pool, that particularly in the second half of this fiscal year?
So, especially in the what you call, there is a slight improvement as far as asset quality is concerned, and even compared to earlier quarters, both in, of course, there is a slippage in the earlier quarters even into our developer book. Now retail segment is showing good improvement, and going forward that should still improve. IHL, if you look at only IHL now, individual housing loan at stage 3 level, I think the ratio comes around 1.68 stage 3. NHC is around 22.38%, and non-housing individual it is at 6.85%, and project is around 42.24% as far as the stage 3 things are concerned across all products.
So project, did you say 22.24?
42.24 because book size has come down.
Sir.
There is shrinkage in the book size over last year around more than 20%. Obviously, even the absolute volume has not gone up in the quantum, but the percentage comes.
Got it. And sir, and finally, what is the expectation of slippages from the restructured pool?
The restructured pool has been behaving slightly, I would say, stable. And in fact, what we had indicated in the previous call also, that there will be recovery on the other side, especially in the retail side. That is something which is working out well. So 700 crores of NP has been reduced on the retail segment, and that has happened across individual home loans as well as the LAP loans, etc. So there is certainly some decent improvement.
Thank you so much, sir, and wish you the very best. That's all from my side.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in this conference call, we request you to limit your questions to 2 per participant only. If time permits, you can come back in the question queue for a follow-up question. The next question is on the line of Mayank Bukrediwala from Citadel. Please go ahead.
Hi, sir. Thanks for taking my question. I want to harp on the same question that Dhaval was asking. Just want to clarify so that 277 crores, the impact of NPV is passed through the interest income line. Now the question is, if I add that back also and adjust it, and if I adjust the other 90 crore also, your loan yields this quarter on a calculated basis appears to be at best flat. While we had taken a 60 bips PLR increase at the very start of the quarter. So just wanted to understand, is there any other impact, or has there been an issue in passing through the rates? That's question number one. And the second is, you're speaking about sort of retaining customers, the good quality ones. But right now we are actually at a relatively large differential versus banks at the rates that we offer, because banks have ballpark passed 100 to 140 bips rate to their customers, while we have passed close to, until the last quarter 60 bips, but there's still some gap versus what we have passed versus the banks. So why are we seeing this pressure to retain the customers? Ideally, we should have some bank customers move to us, because I think our rate is still relatively lesser compared to the bank.
No, Mayank, your second question regarding that there is a gap. Actually, the rate is on the back book, and it is already communicated. The effect will be from 1st of October.
Yeah. So the question is, you ideally, at least until now, you would not have seen any pressure at all, because
no, it doesn't work that way, because once there has been a PLR hike announced in public domain, it is very clear that it will get impacted, and the dates of impact are also predetermined, like 1st October, 1st January, etc. The difference, what you said in the beginning of your query, your first query, is that yes, there is a lag, because in our case we reprice it on a quarterly basis. That is 1st October, 1st January, 1st April, and 1st July. So that is one of the reasons why there is a transmission lag. That also our MD mentioned at the beginning of the call. But having said that, the fact is that whatever
that we took at the very beginning,
60 basis points, I'm coming to that. Yeah, I'm coming to that.
Sure.
That 60 basis points which has happened in June, that is effective from 1st of July, for which we get a 2-month benefit that it is payable, it is due from July, payable August, because that is how the EMIs are done across the country. In the industry, it is on a arrears basis. So the 200 crores is the impact of that transmission, which should have actually got reflected in the interest income.
For 2 months, which is at least we should see on this.
But there has been a 220 crores of interest cost also, which has increased during the similar period. So that has got netted off. 240 crores. 240 crores. So that has more or less netted off. Now your query is that what is the gap between the June NII and the September NII? Is that right?
I'm not talking at the NII level. I'm simply talking at the yield level. Just at the yield level, if I just look at the yield and add that 277 plus the 90, even then the yield does not really go up when you have taken at least 2 months of 60 bips repricing.
No, it has actually, Mayank, it has actually come, because if you compare the yield on the assets between June and September, there is a 47 basis points increase in the yield, overall yield, and there is a 40 basis point corresponding increase in the cost of funds. So the yield of 47 basis points has actually come.
Okay, I'll recheck my numbers.
Please check. Please check. There is a 47 basis points increase which has actually happened on the yield side. 0.2 point basis.
I'll recheck my numbers. Thanks, Sudeep. Thank you so much.
Yeah.
Thank you. The next question is from the line of Umang Shah from Kotak Mahindra AMC. Please go ahead.
Yeah, hi. Thanks for taking my question. Just wanted to confirm, MD sir mentioned that FY23 full year margins should be better than FY22. Just wanted to confirm that.
Yeah, full year basis.
Yeah, on a full year basis. Okay, so FY22 we were 2.3%. On a full year basis, FY23 we should be better than
2.29.
Yeah, 2.29. That's correct. Okay. The second question is on what proportion of our loans would be, let's say, partly fixed come floating, if at all we have such loans?
There will be some very small, maybe around 1% or so.
Okay. So basically about fair to assume that about 97-98% of our loans would be purely floating in nature.
Correct.
Yeah, correct.
Okay. And just last data point, what's our outstanding restructured book now as on end of September?
3,466.
1.some%. More than a percent.
And what proportion out of this would still have moratorium on it?
This is the moratorium piece only, no? This is this is the amount which is not exited from the moratorium period. So that is the reason why it is still considered under the OTR pool.
Okay. Understood. All right. Thank you so much. Those were my questions.
Thank you. The next question is on the line of Kunal Shah from ICICI Securities. Please go ahead.
Yeah, thanks for taking my question. So first, 275 crores impact is on what quantum? If you can just mention by quantum, that will be easy. Is it on 5,000 crores, which is reflected from, say, fixed to floating, or it is on entire 15,000 crores, wherein we gave the benefit last time, okay, to retain the customers? And what was the yield reduction? Okay, because, so if you can just first let me know the quantum.
Around 9,000.
So on 9,000 crore, this is almost equivalent to 3%.
No, it is not 3% because it is actually, it does not work, legally. It is a front-ended calculation depending upon the residual life of the asset, which is estimated around 9 years or so.
Yeah. So 9,000 crores of exposure and 275 crores impact. So that maybe in percentage it clearly translates to 3%
No, it is it is not 3%. It is not 3%. The reduction is not 3%. It is the NPV of the reduction.
No, I understand that. I am saying not the reduction. I am just saying that impact or the modification loss is 3% of the exposure through NPV.
Yeah, that way if you just linearly calculate, yes.
Yeah. And what would be, so when we look at it, now after all this modification and all, how much is the yield that will accrue in future on this portfolio?
Yield in
So we would
terms
have
of
read-
the increase in yield, you mean to say?
Yeah. So
Yeah, see, your calculation is not correct because first of all, it is not a 3% reduction. That 3% you are
I'm not saying
actually.
3% reduction. I'm not saying reduction. That is okay. 3% I understood. Let us keep it aside now. Now, what
So
is
that
the
calculation is not correct.
existing rate?
So just to give you an indication, whenever from the point when we had started converting these loans, from that point to point, we have increased our PLR by 175 basis points.
Floating also.
Perfect.
And it has come to floating. These are all floating. And point to point, the rate increase is 175 basis points. Of course, it has not happened in one particular day. It has happened throughout the quarter.
Yeah, 60 plus
the 2 quarters.
115. Yeah. So that 175 bits entirely it is passed on by way of the benefit, or how is it in terms of the reduction? In terms of the benefit to those clients, it's been 175 basis points benefit which has been passed on when they converted.
Yeah. Roughly you can say. Now it has been almost netted off.
Okay. And going forward, this book will now yield 8% odd only, or it will yield a higher number.
No, currently it will yield more than 8%. It will be at current level. It will be around 8.5.
It is a present applicable floating rate, no?
It is as of 14 rate. It will be charging 8.5%.
Okay. And this 115 bips impact which comes through from effect from November, that will now again not have any implication on this book.
No, I'm considering that also because it is already effective from 1st October.
No, but September results it might not be there. Na? So is it there in the numbers
September
already?
It is certainly not there. It is certainly not there.
Will it further come? Will it further come?
Yeah, it will come in Q3. The benefit will be seen in Q3.
Okay. Got it. And again, so got this thing. And when we look at it in terms of the restructured pool, so last time the commentary was 3,100 crores, out of which 2,100 was individual and 1,000 was wholesale. So the slippage which has happened of 450 odd crores in project, is it from the restructure or it is outside of this restructured of 1,000 crores? Because
can you
that
please
number
repeat the
of
last portion?
The NPA NPA in the project book, you said that was 550 odd crores. No? Delinquency slippage was 540 odd crores. 540. So that is from the so that is from restructured pool, or that is outside of restructured pool?
Yeah, half of it roughly is pertaining to a restructured book.
Okay, so that has already slipped.
Around 350 is from the restructured book.
350 is from the restructured book. So then why actually last time 3,100 crores of restructuring, and even after this slippage, now what we have disclosed is 3,466 crores of restructured pool? Because there is the movement which has happened and it has moved out of the moratorium and slipped as well. Then why there is an increase actually?
No, there is this 370 had already been removed from the restructured pool. As of 30th June, it was not there.
Okay, it was not there, but it slipped in this quarter. Maybe it was already out of moratorium last time itself. Okay.
Yes. It was not there.
Okay. So still there is 1,000 odd crores in the individual outside of it. So when we look at it, 346 is how much is individual and how much is project?
Just a minute. I will give the breakup to you.
The
project and retail.
Corporate is around 2093, 2093, and the other one is 1373.
So last time corporate was 1,000 crores.
No. 1,000 crores has exited. 1,000 crores has exited.
Oh, because last time I thought number was 3,100, out of which you mentioned 2,000 is towards retail and 1,000 towards wholesale.
It was 2,200 and 1,544.
Oh, okay.
2,000. What has exited? What had exited? You're right. That number exited.
Okay. Got it. And any risk on the slippage which we see from this pool? Because we have already seen 875 crores of slippage from the pool that was outstanding as of March. So any further slippage which we expect from here?
Like going forward, I think now we are not foreseeing any such big slippage, but maybe very small insignificant amounts will be there.
Okay.
Now with the passage of time, we are getting some more, I would say, clarity that probably the quality is, at least for the time being, is holding up.
Okay. And lastly, in terms of the scale-based, would there be a requirement to increase the coverage on stage 1 and stage 2? Because that's still at 6 odd basis points on stage 1.
June 6th circular was already operational for housing finance companies for many years. And this June 6th circular only has been incorporated in the scale-based regulation.
Okay. So we can still continue with 6 odd basis points of provisioning on stage 1.
Correct.
Okay, got it. Yeah, thanks a lot.
Thank you.
Thank you. We'll move on to the next question. That is on the line of Ashwini Agarwal from Edelweiss Mutual Fund. Please go ahead.
Hi, good afternoon, sir.
Good afternoon.
So, what in the financial instrument which you had written down, roughly 190 crores, was it fully provided for?
Yeah, it was fully provided for. It is actually not one account. It is almost 950 retail accounts.
Yes.
Sir, but it was, if it was fully provided off, then why it had to be written off? Because
it has to be as per the index. As per the index, what actually happens is that you have to pass it through the P&L.
Correct.
It has to be passed through a P&L, irrespective of the fact that there has been a provision or not.
But isn't it double accounting? But you have already provided.
It is not. In fact, we had also iterated on this internally, but it is not that way. In the index, what actually happens is that, see, there are two different systems of provisioning that happens. That is RBI based, IGAP based on RBI IRAC norms, and the index ECL, which is basically on the probability of default and loss given default, and which actually depends upon the value of underlying security. Correct. So when we actually move it, say for example, a loss asset which is more than 5 years or more than 51 months, then as per the RBI IRAC norms, it is a fully provided loss asset, right? But as far as the ECL is concerned, it does not necessarily follow that same pattern of provisioning. The provisioning depends upon the PD, the probability of default, LGD, that is the loss given default, and the value of underlying security, which drives the loss given default. So what actually happens is that when you write off something which is fully provided as per the RBI IRAC norms, you have to also pass an entry to ensure that the entire asset is removed from the ECL provisioning.
Okay, so you mean to say in ECL provisioning terms, it was not fully written off, so you had to do it?
It might have been fully provided. It is not written off. It might have been fully provided, but irrespective of that, you still will have to move it through the P&L. And there is no double accounting. We have checked that. But good question.
And secondly, the fixed rate loan, which was converted in this quarter, when was this generated? Because if I recollect properly, RBI had clearly said that fixed rate loans, housing loans cannot be generated. So when was it generated?
Who said that? Fixed rate loans today also are being sold. It cannot be fixed, or it cannot be fixed come floaty. Even there also there is no such. It cannot be a step up kind of a teaser loan. But fixed rate loan today are also being sold. Every company and bank has got a fixed rate loan offering. You can also take a fixed rate loan from any bank or HFC.
Okay, when was it
not banned by Reserve Bank?
When were these loans generated?
They would have been generated about 4 or 5 years back.
And another last thing which I wanted to know, in a rising interest rate scenario, why would a customer typically move from a fixed rate to floating rate?
No, it is not the customer who necessarily has to move. No. If the company is facing I would say, put it this way, if the company feels that we are better off in a rising rate scenario for a longer period of time to move it to a floating rate, that is the initiative that the company will also take, no?
Okay. And so my last question, you had earlier guided for roughly 2.3% NIMs for the entire year and 1.2% ROA. Do we still stand by that?
Last year's NIM was 2.29. Few minutes back, our MD has also said that we will do better than last year's NIMs on a full year basis.
And ROA of 1.2%?
We are at 2.17 for the half year.
And what about return ratios, ROA? Will we be around?
ROE also correspondingly increased. You cannot have a ROE and NIM movement without a corresponding ROA improvement. And 115 basis points of repricing is already affected from 1st October. 1st October means that you will get an impact for 2 months during the quarter, November, December. But there has been 175 basis points increase, which will translate to an obvious improvement in the ROS. And as I mentioned just few minutes back, the spreads have already started reflecting some increase over June.
Okay, I'll come back in the queue.
Thank you. The next question is on the line of Rikin Shah from Credit Suisse. Please go ahead.
Thank you for the opportunity. I have 3 questions. First,
sorry to interrupt, Mr. Shah. We are not able to hear you clearly.
Just 1 moment. Am I audible now?
Yes, sir.
Yeah, you are there.
Okay, please. Thank you. Yeah, so looking ahead, if we look at the yields on advances, which as of first half was 8.6%. Now with 115 basis points of increase from 1st October, do you expect that this could probably be increasing by 100 basis points from the current run rate in the second half? Is that a fair understanding, or that may not play out?
No, I will, going by the previous, I would say, instance, there are some NPLs on which the yield benefit does not accrue because obviously you don't collect anything. Secondly, whatever disbursement you do during the quarter, that also doesn't get covered under this immediate rate hike. So in the previous one, that 60 basis points has led to a 47 basis point yield improvement. Going by that, you can expect at least an 80 to 90 basis points yield improvement.
Okay, and in terms of the weighted average cost of funds, which is at 7.1%, how do you foresee that moving in the second half?
I would say that a good amount of the impact has already been absorbed because the successive rate hikes, most of the liabilities which are on the floating rate side was linked to the repo and the external benchmark, that is the 1-year T-bill, 364 days T-bill. Going by that, I would say the majority of the impact for the rate hikes that has happened has been factored in. You will get one more impact a little bit, maybe 15 to 18 basis points impact will come because of the rate hike of September. 50 basis points repo hike of September will translate to around 15 to 18 basis points increase in the weighted average cost on the entire book. And then we have to see what is the increases by Reserve Bank going forward in December. That will outline the future increases. But as far as the overall cost of fund is concerned, one thing is very, very clear that whatever are the repo policy rate hikes, the cost of funds will increase by about less than 50% of that on the entire book.
Okay, understood. And so if I just triangulate these numbers, 80 basis point increase in the asset yield and another 20 basis points, say, increase in cost of fund, assuming no further rate hike, the margins should increase by 60 basis points. The spread should increase by 60 basis points in the 3Q.
Correct.
Okay, fair enough. Second, just clarification on this 191 crore retail write-off. I heard your explanation on difference between the RBI IRAC and the Ind AS norms. But let's say if this asset was a 100 rupee asset, and even as per ECL, you had provided completely as you stated. So the provisions against that was 100 rupees. So now why is there a need to further provide or to write it off, or why additional charge on the PNL to write it off?
See, actually, you have to remove the entire asset from there. What is the outcome of it, or what is the impact of it? So when you actually pass it through the PNL and you do not, which means that notionally your provision on ECL remains intact, it means that you are actually having a slightly better provisioning coverage ratio.
So if your ECL provision was
on the remaining assets, on the remaining part of the stage 3 assets.
So basically what you are saying is that to maintain the overall stock of ECL coverage, you had to kind of take additional charge in the PNL so that the overall ECL coverage doesn't go down.
Absolutely correct.
So basically this charge is not related to the write-off that we did, but it is just to maintain the coverage levels. You took this additional...
Yeah, but only thing which I would like to submit is that had it been under the RBI, IRAC and IGAP, then probably this entry would not have been required.
Sorry, could you clarify this a bit more so that I understand better?
Had it been a fully provided case under the IGAP, RBI IRAC norms, and then you want to write it off, then probably this entry would not have been required.
Okay, so this was fully provided under Ind AS but not under IRAC, and hence this thing.
Something like that, yes. I think you got it the other way around.
Okay, this is still a bit confusing, but I'll move on. Just on the restructured part, out of total 3466 crore, you did mention the split between the corporate and retail. Could you repeat that? And also, I would like the split of this same amount. What would be in the stage 2 and in the stage 1?
Stage 2, stage 1, I'll not be able to give you offhand. But as far as the OTR is concerned, as on 30th September, it is 2093. 2093 crores on the, this is the stage 3, 2093 on the corporate side, that is the builder side. And on the retail side, it is 1374.
Okay.
And stage 2, actually the entire OTR, this OTR is actually stage 2.
So entire 3466 in your stage 2?
Yes. But stage 2 has got other assets also, but this one is, the entire OTR is in stage 2.
Okay, so last quarter 1000 crore was in stage 1. Now all of this is sitting in stage 2.
Correct.
Okay.
If you recollect, in the last quarter, what we had done is that we had moved that you'll find the reference in the call also. We had moved the assets in the last quarter itself to their status pre-existing before the impact of OTR.
Okay. Got it. And the last one is in the absolute amount terms, what would be the NPA number for non-housing individual and non-housing commercial? Last quarter.
Non-housing individual, the stage 3 is 1740. That is for the NHC. NHI is 1766.
Okay, perfect. Thank you so much. That's all from mine.
Thank you.
Thank you. The next question is from the line of Piran Engineer from CLSA. Please go ahead.
Yeah, hi. Thanks for taking my question. Just to clarify once again on this spread thing. So 4 or 5 years back, there were these fixed rate loans, and they've now been repriced downwards technically, and that's why we have an NPV loss of 275 crore.
Correct.
But so when in the last 2 years when interest rates were much more benign, isn't it logical that they would have done it back then? And also, why did we not leave it as fixed rate loans unless we are expecting, significant further floating rate hikes in the next coming years?
So your first question is that when it was actually going down, it would not have been positive for the company to reduce it at that point in time because it would have led to
but the borrower would have wanted it, right?
Huh?
The borrower would have wanted it.
The borrowers would have wanted it, but probably from our side we had somehow managed to convince that this is not the correct time to move, and now we have affected that movement.
Okay, fine. And just in terms of, you all retain 9,000 crores of retail assets from BT out. Again, the question here is that the banks have also increased rates a lot. So where would they BT out, if at all?
Yeah, I'm not getting your query.
Hey, not a BT. BT has not gone. No,
not the query.
No. So you'll try to retain 9,000 crores of home loans and you'll give better rates, right? The point is, in this retention strategy, there was no other choice for the customer but to be with you all because he could not have gone for bank.
No. That is not correct. No, that is not correct. You have to understand that for most of the banks, there is a substantial difference between the onboarding rate and the back book.
Okay.
So the onboarding rate comes with a lot of offers and discounts and waivers of processing fee, etc., just to onboard the customer. But the back book is different. It's the existing customer, and there is a gap between the existing customer pricing and the customer pricing for the onboarding or for the promotional offers. There is always a gap.
Okay. So then let me
across all banks in the system.
Got it. So your best quality customer, absolutely prime, CIBIL score 800 and at floating rate today, what will be his rate after all the PLR hikes we've taken?
8.3.
8.3 is the lowest. That's the best guy, right?
Correct.
Got it. And so this 95 crore reduction in interest income from project loans, what exactly is that about? Because we haven't discussed that.
Because of the shrinkage in the portfolio, number one. And number two is that, as we mentioned, that 540 crores of assets have been classified as NPLs in this quarter. So reversal of income on that.
Got it. And just lastly, we've seen a 10% jump in the OTR book from 3,100 to 3,460. So really, what explains that? Is it accumulation of interest or?
No, there is no such, there is no such accumulation of interest because there is not, there may be some residual accounts would have been there.
No, you are at
3,400.
No,
3,400 is the, 3,466 is the final. Correct.
No, but it was 3,100 last quarter, and restructuring it was not done incrementally in the quarters, so it increased.
So it could have been the case that some part restructuring which would have been affected. That is not slippage. That is just restructuring.
It has moved out.
Last year it was 3,766 as on June. 1,544 and 2,222.
Okay, I think.
Some 300 has actually come down, not the other way around.
Okay, understood. So, and just my question.
Sorry to interrupt.
3,100 had moved out. I think the number that you are getting confused is that 3,100 had moved out of the OTR last quarter.
Okay.
And so overall percentage is around 1.3 only, no? 1.2.
Okay, this makes sense. Just one request, sir. If many of these numbers are not in the PPT, if you could just enhance the disclosures in your PPT.
Yes.
That would be really helpful. It just makes it much easier.
OTR number is actually a published number. It is as per notes to accounts. It is published with full details.
Just in general and extra set of all the one-offs that happen in a quarter.
Sorry to interrupt, Mr. Engineer.
That would be helpful.
Mr. Engineer, may we request that you return to the question queue? There are participants waiting for their turn.
Yeah, sure. Thanks.
Thank you. The next question is from the line of Roshan Chutke from ICICI Prudential Mutual Fund. Please go ahead.
Thanks for the time. Yeah. On this 270.
Mr. Chutke, can you speak a bit louder? You're sounding very soft.
Yeah, please. Am I clear now?
Slightly better. Please proceed. Thank you.
Yeah. On this 275 crores, just a basic question: why did you have to do the NPV of, NPV calculation at all for these 9,000 crore assets, basically?
So that is required as per the Ind AS guidelines, Ind AS 109, no?
Okay, so what is the corresponding?
What is that?
So
voice is very low. Hello.
Can you hear me?
Yeah, your voice is not clear.
It's breaking actually.
Hello. Can you hear me?
Yeah. Please tell.
Yeah, no, I was just trying to understand. Is it because of the fixed to floating? Is it because we never saw any other lender do this kind of a thing when you reduce the rates or increase the rates, right? Why would you do the NPV calculation? And it's just the interest income that you, for example, if it moves from 7% to 8%, or rather the other way around, then you'll have a hit of.
No, it is not that way actually, Roshan. It is not that way. Whenever there is a modification of any financial contract, there has to be either a modification gain or modification loss. Whenever there is a modification. Now, when you are moving some assets from fixed to floating, or it can also happen from floating to fixed, either way, then this will be treated as a modification. And then it has to be calculated what was the rate of interest which was applicable, or the earnings that were applicable on a EIR basis, that is expected interest rate. What was it earning prior to the modification and what is earning post that. So, and whatever is the difference, that has to be applied over the residual life of the asset and discounted at the present value. And that is how it is absorbed. The logic behind that, as per index, is that all your assets are either financial assets or financial liabilities. And whenever there is a modification of any of the financial assets, in vis-a-vis to its earning capacity on a particular day, then it has to be accounted for in the value. And it has to be taken through a P&L impact. That is very clear. That is the standard 109, Ind AS 109.
Thank you.
The reason why it probably has not been visible is that probably the number had been small, so it would not have, resulted in any major kind of a requirement for clarification. Because here the number is very large, that is the reason why it is getting reflected.
Thank you. We'll move on to the next question. That is from the line of Sandeep Jain from Baroda PNP Paribas Mutual Fund. Please go ahead.
Hey, hi sir, thank you. Just one clarification on the ECL side and the write-off has to be moved to the PL side. Has our PD and LGD has increased? Assessment of PD and LGD has increased from the last quarter or last year or so?
No, not at all.
Okay, so I'm trying to understand from the last question also when you have answered that we need to maintain the similar amount of provision and
it is actually enhancement of the PCR.
Okay.
Enhancement of provisioning coverage, which you have seen. Total assets coverage ratio has also increased sequentially from 2.4 to 2.58.
Okay. So now there is some confusion. I'm really sorry for this question, but generally what used to happen is whenever we have provided for some assets and that asset is getting write-off, there is no need to take onto the PL. That is a very logical way, right?
No. That is not that is, as I told you, in RBI that is different. Because here there are two differential calculations, no? So that is not the case in case of Ind AS. It is not the case in Ind AS.
So say here is, I understand, is 100 200 crores of account.
Last quarter also we had written off something around 30 crores that had to be also passed to the P&L. Even that was fully provided.
No, I understood. For example, if
we had done a technical write-off about 30 odd crores, I mean between 20 and 30 crores. So that was also passed to P&L. It is not a practice that we are adopting now.
No, I understood that. Okay, no issues. I'll take it offline. What I'm trying to understand is that suppose if there is some large account or some other account can come and we have already done a quite amount of good PD and LGD on those, account and all. And if that account needs to get write-off, then you cannot take back provision from them. You have to pass it through whatever may be the amount.
Whatever is the asset value, it has to be passed to a P&L account.
You cannot touch the ECL rated provision.
No, you cannot do it.
You cannot do it.
You cannot net it off from the ECL. The very purpose of that is to reflect it to a P&L. Otherwise, there is no space for it in the entire P&L. No, it will just vanish. It will just get removed without any. Nobody will get to know also if it is not routed to P&L.
So your ECL based provision coverage will further increase if that is the case.
It has increased.
Got it.
It has increased. If you see the details that is there on the presentation, it has increased. In fact, every quarter it has been increased. The PCR has been increasing every quarter.
Okay.
Money has not gone out of the system. It is there within the company as a provision.
Got it. Yeah.
Thank you. The next question is from the line of Nischint Chawathe from Kotak. Please go ahead.
Yeah, thanks for the opportunity. Just trying to understand, from a borrower point of view, these 9,000 odd crore borrowers, who moved from fixed to floating. What is the proposition for them? They're probably paying 7% fixed and they're now moving to 8% floating. So is it something that you are giving this kind of a discount to them on the principal amount, and which is where they're willing to convert? Why would they be?
How can be a discount on principal, Nischint?
No, but that's what I'm trying to understand. What is it for them?
The rate of interest has been given a discount itself. Rate of interest. That is the reason why the modification loss is arising out of the first in the first case.
Moreover, they will be for long term also. No?
So these customers would earlier be paying what, 9% fixed or something like that?
No, not 9%, but around 8.5% or thereabouts.
Okay, and then that has probably now come down.
Depending on credit rating, etc., and amount, etc.
So it was 8.5% fixed, which probably came down to 7.5%. So you had to do this adjustment.
Correct.
Now you're saying that
but now that 7.5% is on floating.
That you have again raised it back to whatever.
Correct. The reason is that, see, today we are in an increasing rate scenario, so everybody would like to have a fixed rate of interest. But whenever the rate of interest reverses, cycle reverses, maybe 1 year down the line, 1.5 years down the line, if the loans are still on fixed, there will be exits. Because at that point in time, nobody is going to pay a higher rate of interest at a steep difference to what market is offering.
Sure.
So you have to keep the long-term interest in mind in terms of the entire life cycle of the loan.
Definitely. And, excluding these two adjustments from the interest income line item, you said that your yields are going up by around 40 odd basis points. This is on a year-on-year basis, which is second quarter versus second quarter, or first versus second?
June to September.
That is on a quarter-on-quarter basis, that you're looking at a 40 basis points.
Yes.
Sure. Okay. Those were my questions. Thank you very much.
Thank you.
Thank you.
Thank you. Ladies and gentlemen, due to time constraint, that was the last question. I now hand the conference over to the management for the closing comments.
I thank you all for your active participation. I think from our side, because always there is a good demand for housing, the demand is very robust across all places, and all the regions have already chugged out a very good strategy. I think Q3 going forward, we'll have for better NIMs and also excellent performance across all the parameters. Thank you once again. Wish you all the best.
Thank you. Ladies and gentlemen, on behalf of Axis Capital Limited, that concludes this conference call. We thank you for joining us, and you may now disconnect your lines. Thank you.
Thank you.